Mr. Meddings, profits rise by 28% for Standard Chartered, yet lending's rising by 22%. Are you experiencing a squeeze on margins in Asia in the lending that you're doing there, as we heard from HSBC earlier in the week?
We're seeing some small diminution in the asset margins. But if you look at margins overall, the group margins were 2.3% in 2009, and they fell to 2.2%. Compensating for some of the asset margin pressures is the fact that liability margins have now stabilised. So the overall picture is only a very small decline in the margin. Actually, we're seeing very good levels of business. You alluded to the level of lending growth, but it's not just the rate of asset growth. Our deposits are up 23%, our assets are up 22%. We're seeing very strong levels of actual activity in trade, in corporate finance, across capital markets, across our group overall.
Well, on the question of lending, yes, the numbers look very impressive, but obviously your concentration is on Asia. Are you concerned about asset bubbles in Asia and the potential that that might have in terms of the lending that you're doing?
Well, I mean, I think it's a valid question, asset bubbles. But if you look at our exposures, if you take the consumer bank, our average loan to value on our mortgage book is 51%. If you look at the consumer bank assets as a whole, only 15% of the consumer bank assets are unsecured. So 85% of our assets are secured. So in terms of asset bubbles, clearly we watch for that, particularly in real estate and in stock markets. But we don't have significant exposure.
How real a risk is that Asia could blow up?
We believe that if you take someone like China, for instance, that the underlying factors that support China's growth are resilient, that we'll see continued good growth in China. It doesn't mean you won't get asset bubbles in China, but the Chinese economy itself is not a bubble. And we think that you will see good, long-run, sustained economic growth there. And I think that general point stays true for most of Asia.
I want to move on. Your CEO describes a war for talent across Asia, Africa and the Middle East. Now look, this has got to have an impact in terms of costs. Your costs are rising by 13%. If you're chasing human capital around Asia to build your business, does that mean that we're going to see higher costs again going into 2011 if you want to attract the best talent?
It's certainly true that we are a very attractive destination now for people. Our franchise is a good franchise. It's growing strongly. People want to join us. What you saw in 2010 was an increase of 9% in our headcount. We purposefully went out and hired. So we hired over 7,000 additional people in 2010. Our expectations for 2011 will be that we'll add a net just under 1,000 people. So our rate of hiring, our net hiring, will actually reduce in 2011. One of the ways we'll control costs actually is through that rate of hiring and also the rate of replacement hiring as we see staff turnover.
Return on equity is a burning issue in your industry at the moment. Barclays guided lower, Credit Suisse guided lower. Any plans at Standard Chartered to lower our levels of expectations from you in terms of return on equity?
We have not changed our guidance on return on equity, and we believe that through the medium term, given the growth of our franchise, the growth of the markets we're operating in, our ability to take share and win more business, that the return on equity will stay in the mid-teens. In 2011, we'll need to think about the immediate one-year impact of the rights issue done at the end of last year, so returns will be suppressed a little for that. We think about 150 basis points, and we have to take into account the impact of the bank levy. But through the medium term, we haven't changed our guidance. It's mid-teens ROE.
Any more plans? You mentioned capital raising, obviously, at the end of last year. Are you done and dusted in that sphere? You're happy that you've raised sufficient capital? No more need for capital raising?
If you look at our balance sheet, the assets are very diversified, and secondly, our capital ratios are about as strong as any, I think, in the industry, certainly for an international diversified bank. So core equity is now at 11.8% and total capital at 18.4%. We did the rights issue to move us above the fray in terms of potential regulatory changes and regulatory evolution, and in doing so, giving us capacity to continue to provide good growth as our customers grow in terms of finance facilities and lending.
Well, let's just focus on regulation for a moment, because again, going back to what Peter Sands had to say, that the biggest challenge is that regulation lacks global coordination, lacks consistency. So if that's the challenge, how's that going to play out for your business and potentially for the economies that you operate in?
I think there's at least a two-pace world going on. It's probably more paces than that. You can see Asia continue to grow very strongly, and you can see much of the West still, I think, very fragile. Because of, in part, regulation, the deleveraging process has not yet worked its way out in the West. So I think we'll still see continued economic pressure on the West, in part due to regulation. The challenge of regulation is that if it's brought in unevenly, if it's brought in differently by different jurisdictions, it simply becomes a much more complex world in which to manage.
Well, with that in mind, the UK Chancellor, well, he levied $180 million. That's what it looks like it's going to cost you in 2011. Was George Osborne fair to levy that amount of money against you guys?
Look, we understand the political motivation behind that, and in many ways the social motivation in terms of seeking to take higher revenues from the sector. 95% of our business is done in Asia, Africa and the Middle East. So the UK bank levy, I think, is essentially a charge or a tax on depositors in many other markets brought back into the UK.
Got to ask you, is George Osborne doing enough to entice Standard Chartered, HSBC and everybody to remain in the UK? Or indeed is he still holding a stick over you?
I think it's a matter for the board, for the board of Standard Chartered, and we have no current plans to leave the UK. We have no wish to leave the UK. But it's quite clear that we will keep on our radar potential changes in regulation as they emerge. And the only thing I think that could really make us move would be, I think, super equivalent or uneven regulation attaching to the UK. But we have no current plans to move domicile.
The burning issue for the markets is the threat of inflation, rising oil prices, potential double dip. Is that the biggest challenge for you in terms of the markets that you operate in? Is that what worries you when you go to bed at night?
Well, we clearly keep an eye on consumer price inflation and on asset price inflation, and we need to watch that. It impacts both on costs, but also impacts on credit. So in high inflation environments, it can cause stresses. It causes significant credit pressure. So clearly we watch that, and we watch that very closely. But to be frank, the most significant risk that Standard Chartered runs is the regulatory risk. So what is going to happen to regulation? That's the most significant challenge we have to think about.
And just one final question, very quickly. Apart from Asia, where else do you go for growth, sir?
Well, we are Asia, Africa and the Middle East. We have a very clear strategy that we locked into and refreshed recently, but locked into 7 or 8 years ago. It stood us in very good stead. We see no reason to change that strategy. We've invested in 2010 behind it. We've grown our balance sheet very nicely, maintaining a good, differentiated, diversified balance sheet. We're well positioned in Asia, Africa and the Middle East, and we believe that those will continue to underpin good growth going forward into the medium term.
Richard Meddings at Standard Chartered, thank you very much for taking the time to be with us today.
Pleasure. Thank you very much. Thank you.